Well, good morning, everyone. We'd like to welcome you to the August 27th edition. It's a hot and steamy one here in the state of Ohio, and we're glad that some people are able to tuck indoors this morning to join us here for today's Farm Office Live. I'd like to introduce our part of our Farm Office team, Diane Shoemaker, our OSU Extension Field Specialist, and dairy production economics. Barry Ward, Director of OSU Income Tax School and Leader for Production Business Management. Peggy Hall, Director of our OSU Ag and Resource Law Program, and myself, Agriculture and Natural Resources Educator over in Coshocton County, and doing all the magic behind the scenes. And we would be lost without Julie Strauser, our OSU A&R Program Assistant, and Jeff Lewis, a Research Specialist in our Ag Law Program. Behind the scenes are making this webinar flow and answering your questions and making sure all the difficulties behind the scenes are taken care of. I already see a chat came in about handouts, and yes, absolutely, handouts just like we have done in the past. Those are on our Farm Office website, and Julie has already put those into our chat box. So if you want to see today's slides, you can download those to our computers. And if there's something that you miss or you have to step away during part of the program, just know that you can go back there and see a recording of today's program as well. And today we are extremely excited that we have two guests, and this is maybe the first time we've done that here on our Farm Office Live since we started these programs in the pandemic. And we're very pleased that Robert Moore, attorney for Wright and Moore Law Company, will be on today's program, as well as an old friend to Ohio State, Ben Brown, who is now at the University of Missouri. Both of them are going to address two topics which are really on the minds of many in agriculture across the country. First, the changes in estate tax and the discussions of changes in estate tax, as well as grain marketing. And I know Ben's going to give us his forecast and his crystal ball, as we always like to bug him at this time of year, what's going to happen with crop prices. Again, our lineup for today, we're going to start with an update on tax issues. Barry Ward's going to talk about update on the tax issues. And then Robert's going to dovetail right into that with tax planning in the midst of uncertainty. A lot of uncertainty, not only across the globe, but even in our legislation out in Washington, D.C. Barry is unrolling the Ohio Cropland Values and Cash Rent Survey. And there is a newly article on our Ohio Ag Manager website just last night on the Western Ohio cropland values, which Barry will talk about, but talk about some cash rents. And then I thought it was going to be a real quick update, but there has been some movement with just in the last 4 days for our Farm Service Agency programs, some of the programs, federal programs, pandemic assistance programs that our farmers might be interested in. And we're going to cap off today with Ben on the grain marketing update. And again, and just as a reminder going forward, our next one will be on September 23rd. I'm going to try something different because our September 23rd Farm Office Live will be live again, but it will be live from the Farm Science Review on site. So we're just crossing the fingers that the technology and everything works for us to have that out at the Farm Science Review. But you can catch us live from there on September 23rd, again, back at 10 o'clock. And just as a few reminders, and I mentioned this already, the slides and the recording for today's presentation can be found at go.osu.edu/Farm Office Live, as well as any of the previous recordings that we've been doing since we moved into the pandemic in early 2020. Again, if you have questions, the Q&A box is where we're going to direct you to put those questions in. We will be monitoring that. Some of those questions may be answered live. Some of those may be answered behind the scenes, but we'll try to make sure that those are answered. And again, you'll have all of our contact information. You're welcome to email any of us with your questions. If not, you can funnel those to me at marison.2 and I'll get them out to the team as well. And Julie is also, you can email them to Julie and she'll get them as well. And then finally, the evaluations are key to us. In order for us to continue to offer out the high quality programs, we have an evaluation on the backside when you exit. I'll drop that into the chat box towards the end of the program as well. It'll take you a couple minutes to do that, but know that we read those. And because of the comments that we've received in our last one is the reason that we were able to to get Robert and Ben on board to help us out answering some of those questions that were put into those evaluations. So those are very, very important to us. So thank you for doing that. So with that, I think without any further ado, we'd like to wish you all welcome to today's program, and I'm going to turn it over to Barry Ward. Barry.
Okay, thanks, David. Appreciate that. And I just had a momentary lapse there. I figured I needed to unmute myself, right? So
that always helps, doesn't it?
It's great to be with all of you again, and hopefully you've had a great month between when we saw you last in July and now. Weather conditions have been pretty good, I think, throughout Ohio for the most part, although there are some areas that maybe had a little too much or too little rainfall. And frankly, here around Urbana, we probably could use a little bit of rain. It's the first time all summer that we've maybe been a little bit deficient, but I shouldn't complain too much. I know there's other areas in the country that are much worse off than us. And David may mention this later, but I'm going to introduce this idea now. And he mentioned Farm Office Live. We're going to be coming to you next month from the Farm Science Review. We hope you'll come out and see us also. All of our team is going to be in the Fireball building, and David's going to be running the Ask the Experts session there in OSU Central, and he may mention that later as well. But we hope that you'll come out and join us. We've got a lot of information, and we'll be able to interact in person. So that'll be kind of nice compared to where we were last year, all virtual. Okay, so I'm not sure who set up this lineup on the agenda. David, is this your fault that we put taxes first? But maybe we're just getting that out of the road, right? But we are going to share an update, a little bit of an update on what we know right now on the big federal legislative proposals and also the tax ramifications that might go along with those. So we're going to share a few slides and some new information. Some of this is review from what you saw last month. So right now, what we're looking at, everybody's following this, right? The bipartisan infrastructure plan, the federal legislative proposal that we know and that they're discussing right now. This is the one that we're looking at and they're discussing that's going to have roads and bridges, modernizing and expanding mass transit and rail, all of these different things, and importantly to rural communities, perhaps, maybe more so than anything, is upgrading infrastructure when it relates to connectivity issues. So rural broadband and all those issues that go along with that. So we're calling this a bipartisan infrastructure plan. You know, they did have a team that came together to put this together. However, there have been some stumbling blocks along the way as we read about it in the news. So we're kind of holding our breath right now and waiting to see how this progresses through the Senate and whether or not the House will even take up the vote without the other proposal, the Senate proposal that I'll talk about next, whether or not that one actually gets a vote as well. So there are some issues ahead for this, but the Senate budget resolution, you know, this is the other piece. I just talked about the bipartisan infrastructure plan. This Senate budget resolution, this is the $3.5 trillion resolution that was at least passed through in a preliminary vote. And what we're waiting on is really more detail on this. Now, we know what some of the detail might be from the two proposals that were pushed out by the Biden administration earlier this year, the American Jobs Plan and the American Families Plan. Those two are kind of the basis for what we're seeing in these new proposals. The one that I just mentioned, the bipartisan infrastructure plan, and the Senate budget resolution. So these are the twins that we're following right now as we're seeing how they may or may not go through the legislative process. But the Senate budget resolution may include a number of these things that were in the American Families Plan earlier on this year, some of which has to do with more tax credits, especially for families with young children, and also an expansion in terms of what we're seeing as far as assistance with education, pre-K and also post-high school. So That's where I think a lot of the money will eventually be funneled to. Also, expansion of the Affordable Care Act subsidies, so strengthening that, if you will, and a number of other things, expanding what we might see in other areas, but a lot of that going into tax credits and education. Now, the Senate Democrats who have pushed this proposal, they're saying that they're going to pay for this, and how they're going to pay for it is through some changes in the tax code. So these offsets, what might they include? Well, this first bullet up here at the top, this was a quote coming out of Ron Wyden's office, Senator Wyden, and revenue raising plans will fall into 4 categories: a multinational, where they're going to be taxing multinational corporations. So making sure that those companies that have offshore income, that they're going to be paying more appropriate amount, perhaps, targeting the wealthiest individuals, enforcement against wealthy tax cheats, as they mentioned here, and savings from other programs. So those are the 4 big kind of areas that they're looking at, in the ways that they're going to provide offsets for this big $3.5 trillion proposal. The offsets, a lot of these have been highlighted in the past. Raising that tax rate for that top tier, or that top bracket, to back to 39.6, so back to the pre-Tax Cuts and Jobs Act percentage. Lowering the income thresholds. The third bullet there, this is a big one, especially for farms. Long-term capital gains would be taxed at ordinary tax rates. So instead of 0, 15, 20%, we would be taxing capital gains as long as it was above $1 million. So there's a pretty big exclusion there for most taxpayers. So many would not ever have to come into contact with paying ordinary tax rates on capital gain income. But for those that are going to be higher income earners, it will perhaps impact those folks. Income over $400,000, presumably not otherwise subject to FICA or self-employment tax, perhaps might be subject to this 3.8% net investment income tax. That's been a part of the earlier discussions. So that net tax, that net investment income tax, would apparently be extended to non-investment income if you had income above this $400,000. And that's an important number to remember, because that net income is the one that has been discussed a lot by the Biden administration. If you're above that, you're probably faced with looking at more taxes. If you're below that, they're saying that you're safe. Now we'll see how that plays out, but that's been the discussion throughout the campaign and even into an early part of his presidency. Okay, here's the big one that we talked about last month. This is the one that has a lot of farmers and a lot of small businesses concerned, and that's this idea of taxing capital gains at death. Okay, so if we have assets that appreciated in value while we own them as a business owner, at death, what we typically have and what we've had in the past and what we have now is this step up in basis. That's what you're going to hear. You've heard it in the news. The step up in basis. So our heirs, for instance, they would get this property at a new basis, a new tax basis. And if they were to turn around and sell it, then they would have no capital gains to pay tax on. I'll show you an example here in a moment. But this is the big one that I think has most people concerned. A lot of our farm organizations have really gone to a lot of expense lobbying against this issue, and have really been discussing this with a lot of their congressmen, a lot of the senators across the country. There is a couple of things that I think, even if it does pass as a part of this proposal, that there are some exemptions, some carve-outs for lower income and or small business owners, including farmers. So there would be a $1 million per person exemption. So this is going to alleviate some pain for a lot of people if we do have this new tax proposal as a part of new legislation. And the other thing is that if you have active business owners, heirs, so if your sons and daughters are an active farmer, an active part of your other small business, there would be some alleviation of that tax on that gain. Now we haven't seen any details really on that. They've just said that that's going to be a part of any proposal and any tax change that might occur. So treating property transfers at death as a sale, if you want to think of it that way, we would have this $1 million exclusion per person on that capital gain. So if you had a gain of $1 million, it would not be subject to this particular tax. We don't know yet what that tax basis would be on that exclusion. So a married couple would have $2 million. So under current law, as I mentioned before, there is no tax on that unrealized gain at death. Okay, so you're going to get that tax-free step up in basis for your heirs. Okay, so, sorry, I rushed right through that. There's a number of other offsets that have been discussed. The one here at the top is the one that also has gotten some attention. And that's because some of the Republicans have pushed back against this, is that basically giving the IRS more money to conduct more enforcement. And so that's one of the principles of what the Democrats have discussed as a part of that proposal going forward. But there's a number of other things. Some of these may or may not be included if they do get this proposal to a vote, but there's a lot of offsets that are included in this. Here's the example that I wanted to just touch on, and I talked about this last month as well. So this taxing capital gains at death. So for instance, if you had a farm that you purchased in 1988 for $1,000 an acre, that's the tax basis, assuming you didn't have any other things that you might have added in terms of infrastructure. Farm passes to heirs this year. So this particular taxpayer is deceased this year. The farm's valued at $9,000 an acre. All right, under the current law, the heirs receive this property with a stepped up basis of $9,000. So they would then have that as their tax basis. And there's not going to be any recognition of that $8,000 gain, that capital gain that occurred during their lifetime. The proposal may require, the proposals that are being discussed may require a recognition of that gain. This is the big change, and especially for farmland owners that have held land and have seen a lot of appreciation and value, which we have seen. So this is the issue that everyone's following pretty closely. You know, this is beside the fact that the estate tax, the unified exemption, unified credit may be changed as well, but I'm going to leave that discussion for Robert in a later time, perhaps if we don't get to it today. But we know that the unified credit is now $12 million per person. That's adjusted for inflation, I think, and but that is going to sunset back to $5 million adjusted for inflation after 2025. So that's a separate discussion altogether from this recognition of capital gain. And if we do see this, there's been some discussion, if this is a part of any tax proposal, that there would be some offset with any estate tax that might be due if a person was subject to both. Now, we don't know yet. We haven't seen any real mechanics of how that might happen, but that's been the discussion. Protections for family-owned farms. I mentioned this earlier. Assets passing to farming heirs, so those that actually filed a Schedule F that are active farmers would not be required to recognize that gain on that asset that's passed down to them. Would it simply be deferred? There's a lot of questions here. We don't know yet how this might work if this proposal and this tax piece was a part of new legislation. Would this unrecognized gain and tax due become a lien on the assets? You know, we've had some discussion, and it's something that we brought up with some of our lenders and those folks in financial institutions. This could be a concern. One of the alternatives that I've heard also been discussed is, instead of this tax on capital gains, if we're going to have assets that are going to pass to heirs, especially the active heirs or any heirs, perhaps they would retain the decedent's basis. So in other words, it would be like it would have been a gift to these particular heirs. So instead of having a step up in basis and recognizing the gain and having to pay tax, we would simply just get the assets. The heirs would get the assets, but they would also get the decedent's tax basis. So we would have that $1,000 tax basis from our example. The heirs would have that. So when they eventually sold that property, it might be a hefty tax bill. Okay, so that's one of the issues. And I think this alternative here, I've heard rumblings that this might have a little bit more bipartisan appeal than some of the others. Okay, employee retention credits. There's been some changes. I just want to make sure that everyone understands that these are available through the end of this year. Now, I think the places, farms that might have an opportunity to use these are more than likely livestock operations that might have seen some dip in gross receipts. Crop farms, it may be difficult to qualify. Basically, you're comparing your quarters in 2021 to your quarters, the same quarters in 2019. And if you're less than 80% of those in 2019, you're eligible to claim these employee retention credits, even if you have a Paycheck Protection Program loan. All right, so you can use both. So if you have a quarter that qualifies and the next quarter automatically qualifies, you can claim the credits by simply reducing your payroll tax deposits, or you can claim a credit on Form 941 or 941X and get those payments. However, there's a lot of backlog, so don't expect that to occur very quickly. There's some new IRS guidance that just came out this past week. Safe harbor for taxpayers. You don't have to include your Paycheck Protection Program loan forgiveness as a part of your gross receipts. So if you thought that was going to disqualify you, you don't have to worry about including that. Okay. And we wouldn't be complete on a Farm Office Live session without mentioning the Paycheck Protection Program, which has been a part of every Farm Office Live discussion that we've had since we started these back in the spring of last year. There is a new development here. The Paycheck Protection Program loan forgiveness portal is open. It streamlines applications for loans that are $150,000 or less. And lenders, however, must opt in. So your bank must opt in, and some lenders have not, especially some of the big lenders. So if you fall into this category where you have a PPP loan that's less than this, you want to push through your forgiveness application, and your bank has allowed it, then you can do it yourself through this Small Business Administration direct forgiveness portal. It might speed things up for you. Okay, that brings me to the end of that discussion. Hopefully I didn't rush through it too much. It's a balance, right? You don't want to dwell on some of these things too awful long. Some of it is review. We're continuing to follow what's going on and trying to find out whether or not, keep up with what all of these proposals, especially the big two, this bipartisan infrastructure plan and this Senate proposal that's being forwarded. There's a lot of politics involved in what's going on there. So we're not sure yet whether or not there will be enough votes to push either of them through. I guess I would probably bet on the infrastructure plan before I bet on the other Senate proposal. Okay, with that, I am going to, I think, turn it over to Robert.
Correct.
Yep. And are the slides working, David?
You're looking good, Robert.
All right, I think I might have had some things moving around there. So I'm the new guy, so sorry. Well, I appreciate you having me on, and I'm glad Barry went first because he did the hard part of the tax discussion. So our firm works with primarily farmers, and I don't remember a question that's been more consistent or clients than what's Biden going to do on taxes. Probably once a day we're getting that call from a client, and we meet with many clients who come in really to just focus on that one issue. So what I'll do is I'll give you my thoughts. I'll give you kind of our strategy as to what we're doing, and hopefully that can help you some. I'll give you a bit of a preview, and I will say we don't have any definitive answers. At this point, I don't think anybody does, or if they do, I don't think they're being completely sincere about that. So, but I'll give you some of the strategies we're talking about with our clients and go from there. The first thing I typically start out with clients is a little bit of a civics review. I'm always a bit surprised how many people think that the president has unilateral ability to change tax law, and that is not correct. The president cannot change tax law. The president has no authority to change tax law. Now, a president can say, here's what I'd like you to do, but that's as far as it goes. The Constitution expressly provides the power to Congress to collect taxes. So we start with that, explaining that, you know, any tax law changes have to go through Congress. And then we talk about the narrow margins in both the House and Senate and have that discussion of tax laws aren't easy regardless of who's in control. And they're not easy regardless of the margins in either house. So with that discussion, it tends to put people a bit more at ease that there's not going to be wide sweeping changes implemented by a president. Okay, this is a process that takes a lot of people involved. So then we talk about the politics, and you know, not that I'm, you know that much about politics, but I try to keep up enough so we know, you know, where things stand, who's thinking what's the possibilities of things happening. And our opinion is there are moderate Democrats. There are moderate Democrats in farm states that are going to be reluctant to make really radical changes that are going to trigger significant tax for farm families, like making, you know, all assets transferred at death essentially a sale, or, you know, anything over $1 million would be devastating to farmers and farm families. And to me, it just seems unlikely that Democrats in big farm states are going to be very quick to jump on that plan. I could be wrong, but that's my thought. Then we get, well, when will tax changes take place? You know, will they be retroactive to the beginning of 2021? I don't think that will happen. If we were sitting here in February or March, I did have a different opinion then. Any legislation, it seems, is not going to get passed till October, November at this point. It just seems really unlikely that they would make that retroactive. It just seems completely unfair to people who are making decisions based on one set of laws to now have the law changed out from underneath you, and you can't go back and undo what you did. Also, you know, will changes take place when the law is implemented or when the law is even introduced? That's been talked about too. I think that's unlikely as well, because think about, if you're a tax preparer, you've got, you know, one way to handle capital gains through November 1st, and then you've got another law tells you how to capital gains the rest of the year, and it's based on your level of income. Well, was that the level of income through November 1st for the whole year? Yeah, it just seems that would be totally chaotic, and the IRS would have to have forms, you know, tax forms ready to go based on the new law, you know, early in the year. And I don't think the IRS could react that quickly. So our best guess is that changes will take place. Any changes that will take place January 1 of 2022. Then when will the changes take place, as in when will legislation be introduced and passed? We think if it's going to get done, it's going to get done this year. Next year is an election year in Congress. Typically, Congress has not wanted to deal with tax law changes in a year of election. And then, in 2022, there's pretty good chance, if you just look at history, regardless of your political leanings or anything, if you just look at history, there's a pretty good chance that the Republicans will hold either the House or Senate or both. And if that happens, there's not going to be any tax changes, or at least nothing significant. So what taxes should we expect? I think there will be some changes. I think that's, if there is a definite from all this, there will be something changed. I think high income earners over $1 million, I think they ought to be concerned. Fortunately for most of our farmers, most of them would be under that $1 million annual income, so they should be okay on that. And then even if there are big changes, I just think farms and small businesses will likely have some kind of exemption. Farms and farmers already have an exemption in the law where they can value their land at farm value instead of fair market value, as long as an heir farms the land. I could see the exemption really dovetailing into that and just extending it to those capital gains issues at death too. The loss of stepped up tax basis would, from a tax standpoint, in my opinion, without penciling all this out, but the loss of stepped up basis probably would cost farmers more money than anything. When a farming heir inherits $500,000 of farm equipment, doesn't have to pay a state tax on it, but can redepreciate it, it's a tremendous benefit to that next farming generation. So if we lose the stepped up basis, that would be hard to overcome, and there's really nothing we can do about it. If you lose a stepped up basis, it's gone. There's really no strategies to create it or anything else. So that's definitely an issue we're looking at. Then anything is possible. I was talking to a client in late December, and I'm like, there's no way Georgia is going to elect two Democrat senators. I think we're fine. Well, then whatever that was, January 6th or whatever, I got a call and was reminded I was wrong. So anything is possible. My guess is just as good or just as bad as anybody else's. Already covered some of this. Retroactive, unlikely. I think even when introduced or when passed is unlikely. Just really would be difficult for tax preparers and the IRS to deal with. So we're thinking January of next year is when it would be implemented. Hopefully, and why this is important is hopefully once the new legislation is confirmed as what it's going to be or implemented or passed, we will have time to react to that. So whether we need to do some gifting or that's around or some business restructuring, our hope is we have time to do that. And if legislation is passed in November and it doesn't go into effect until January, it's pretty tight, but at least there are some things we can do to react to it. So what should we be doing? Our philosophy is wait and see. I hate to tell a client, well, let's go ahead and gift all your land to the kids. when it could be that once the new legislation is passed, there was absolutely no reason to do that. And we've missed out on a big stepped up tax basis gain that, we could have had if we didn't gift, or now mom and dad don't own the land and they're a little nervous about that. So I just think it's too speculative to make major decisions. Now, we have had some clients who said, I know taxes, state taxes are going back to $1 million. We're going to have all these capital gains. I know that's going to happen. And that's fine. Their guess is as good as mine. So then in that case, we'll go ahead and do some gifting or whatever we need to do, assuming that that's how the tax changes will develop. Keep an eye on things and be ready to act. And what I mean by that is at some point, this legislation will get to a point where we're pretty sure what's going to be in it, and we're pretty sure it's going to pass. At that point, if needed, we need to be able to start gifting assets, restructuring, whatever we need to do. So be knowledgeable, be ready to act, know what your net worth and earnings potential. If you haven't done a balance sheet in a few years, go ahead and do that now. Land prices have gone up in the last year a lot. So I think a lot of balance sheets are outdated at this point. Also know your earnings potential. If your income is going to be over 400,000 and probably especially over $1 million, there could be some really significant taxes on that. And maybe we need to find a way to get your income lower, or maybe start spreading it over to more people. Find good information, sources like this webcast. Sometimes I can tell where the client gets their information from, just from their questions. And if I say, well, the president can't change tax law, and they kind of push back and are skeptical of that, I can kind of get a sense where they get some of their information. So find good information, university, unbiased people, accountants, attorneys, educators, and try not to get as much information from entertainers is what I suggest to our clients. So with that said, I don't know that I really told you much. It's very speculative. Our opinion is let's wait and see. I'd rather wait and see and make adjustments to a known than sit here, guess, make very important decisions based on pure speculations and be wrong about it. But for those people who are quite certain that they know what the tax law will be, then gifting, irrevocable trust, new business structures with multiple owners, all those are available tools to us that we may consider using. So, all right, that's it for me.
All right, thanks, Robert. Yeah, we appreciate that plug maybe for more Farm Office Live. Okay, forget watching Fox News, MSNBC, CNN, all that stuff. Just come here for all of your news and information. I think that's what you said, right?
I was being a little more diplomatic, but yes. In particular, those cable news sources may not be your best source of tax advice. Yes.
Yeah, well, we try to be as middle of the road as we can be here and give you just what we know and the facts. And we're not always, of course, on the cutting edge of what's going on in the political realm, but we do try to keep you informed on these issues, and we're going to continue to do this. And for what it's worth, I totally agree with Robert on his planning pointers. So thanks for being with us, Robert. Okay, we're going to switch gears unless there's any questions, and I don't think there are. There haven't been any that have shown up. Before I go any further, I do want to just say that I've got guests in my studio today. So I want to introduce real quickly a person that could talk more about this issue than I could is Alan Lyons. And we're going to talk about cropland values and cash rents. Alan, Professor Emeriti with ADE and OSU. And also the reason he's here today is he's with a farmer that we both know from Ukraine, Volodymyr Shulyak. And Volodymyr is over here with his son, who is now attending Ohio State University. So I do have guests in my studio today, so I want to welcome them. And you can't see, well, you can kind of see them behind the fake oval picture that I have in the background. So guys, thanks for being here. And
it's a rare opportunity for me, I'll tell you.
All right, a little bit of a.
Yeah, so everybody.
All right, thanks, guys. We're going to give them a tour of the farm here later on. So sorry to digress. We're going to talk a little bit about some data, Ohio cropland values and cash rents. This is the new NAS data, the National Ag Statistics Service data that came out in August, showing us, at least according to the June area survey and the results that they have from their survey efforts, what farmland values have done across, farm real estate values have done across the U.S. and here in Ohio. And here's the map. We saw about 3.3% increase, 3.9% increase, $6,600. This is farm real estate values here in Ohio. And cropland values is the other measure that they follow closely, and along with pasture values and cash rents, which I'll show in a moment. Cropland values, $6,800 per acre on average throughout Ohio, 5.3% increase. So we did see some increases, and we continue to see this anecdotally across Ohio as we look at auction results and other results of sales. So we did also, and I did collect the information off of the National Ag Statistics Service website on cash rent changes, and the cash rent in Ohio moved up about 2.6% to $160 per acre on average. So we did see an increase there as well, according to this survey data. Now, we just recently completed our survey as well, and we conduct ours in the winter, and typically we like to have our summary done earlier in the summer, but other things have kind of gotten in the road, unfortunately. But we just did recently complete this survey summary, and we have been publishing only Western Ohio, mainly because of the data and having enough data for Western Ohio, not having enough for Eastern and Southern Ohio. We rely on ag lenders, farm appraisers, other ag professionals to supply us with information, an opinion-based survey, just as a reminder. So the survey was conducted in the winter, early spring. What we saw overall, as far as our survey respondents, showing that land values increased depending on the region and the land class, 3.8 to 5.3% from 20 to 21 as far as projection. Cash rents around 3.5 to 4% increase. So we asked them, what was last year and what is their projection for the upcoming year? So we've got the data, and this is now available on the farm office site as well. So you can go to our farm office site. And David also mentioned it's an article in the Ohio Ag Manager newsletter highlighting some of the high points of the survey results, and also directing you to where you can find the information. This is all of what we term Western Ohio, part of the kind of Corn Belt region, if you will, of Ohio. And we can see here that the values for average land in this region, around 180 bushel corn ground, around $8,300 an acre, renting for around $207 an acre. Pay attention to the ranges, because we know that there's differences between Williams County and Darke County. Those are certainly not going to be the same, but we do have subregions that we'll show you here in a moment too. Top ground, and this is land that we don't divide these neatly into thirds typically. Top land in any of these regions is only going to be large tracts of highly productive land. So it may only be 10 to 15% of all the land in this particular region. But we're talking about highly productive land. It's going to sell for more, it's going to rent for more, and it's going to produce more. So we can now look at the subregions. That's all of Western Ohio as we define it. We look at Northwest Ohio. I know this is not a homogeneous region. It's not all the same from Morrow County to Williams and from Van Wert over here to Ottawa. We've got different kinds of soils, different conditions, but relatively speaking, it's a similar value and rental market. Again, it's not going to be the same, but relatively speaking, it's similar. So average 180 bushel corn ground, around $7,900 an acre, and around almost $200 an acre for rent. Now, we realize that we conducted this survey in the winter. You probably have seen some auction results in your area that have surpassed even maybe this top ground for Northwestern Ohio, showing about $9,200 for that top ground where it would sell for, and renting for around $250 an acre. We saw some increases, and you can see from 20 to 21 as far as our survey respondents and how they felt the market would move from 20 to 21. Southwest Ohio, or what we consider, at least in this definition, it's more looking like West Central Ohio, I realize, but overall the market and the rental market are both a little bit higher than this Northwest Ohio subregion. And you can see this top ground selling for over $10,000 an acre on average. Okay, on average, there's going to be some top land that probably will sell for less than that, some that will sell for decidedly more than that. And I know we get pushback sometimes from regions that don't necessarily look exactly like our results. There's going to be some regions, Mercer, Auglaize, Dark, the top land is going to sell. We've seen some of these results lately, $12,000 or more per acre. So there are going to be outliers, but I guess the comment that I would make is that the trend that we've seen is strength in the markets from 20 to 21. A lot of that driven by both government payments as well as higher prices and higher net income. A couple of other graphs that I'll just show you. These are some things that we put together as far as percent changes in land value. And we look at these subregions, Northwest and Southwest, as far as the changes in land value from one year to the next, anywhere from 3.8 to around 5.3%. So, and that may not capture all of the change. And if I had to guess, it's not going to capture the full movement of land values from 20 to 21. Again, we took this survey in the early part of this year, and what we've seen is continued strength in Ohio in terms of both yields, the outlook for yield, and also prices have remained pretty high. This is showing another look and comparing. We look at cash rental rates. We've seen some increases. However, what we typically see in an upward moving land market is rents will lag. And we see this year. I have a feeling, though, that there will be significant pressure and a lot of difficult conversations late this summer into early fall as landlords may want to readdress these rental rates. The one thing that I would caution is that as you work through these issues and these rental negotiations is that these prices are likely not going to be permanent. And what we'll typically see in a bull market like this is that we'll see a bear market follow, and what that will mean for net income, lower net income, and less money to pay for rents. So that's another discussion for another Farm Office Live, and we will address some of those lease issues and that kind of discussion between landlords and farmers in the future Farm Office Lives. But you can see as far as how much per bushel of corn, so about $1.10 to $1.20 per bushel of corn produced as far as rent, and the percent of land value. And with that, I will conclude those remarks as well. Yeah, I've got a comment here. Farmland in Putnam County just sold for $15,000 an acre. Yeah, we're hearing some of those instances, and I was in Wayne County just within the last month, And that's that particular region too, seeing some of those $12,000 to $15,000 per acre sales. So the market is pretty hot right now. All right, and I'll conclude. Thank you all.
All right, appreciate it, Barry. So we're going to move on now to a federal pandemic assistance update. Again, if we were 10 days ago, we thought, well, there would be nothing to share. But here in the last week, there's been some movement. We've been giving traditionally, it's kind of like PPP. We've been talking about CFAP. Every time that we come on one of these programs, CFAP has been open. $13.8 billion has been spent just in the CFAP 2 program. $348.1 million of that has come into Ohio. Of course, that's slowed over the last month. So what are the updates for you since we were here a month ago? Well, first, just as a reminder, the USDA had reopened CFAP 2 for at least 60 days back in April. So on April 5th, it was supposed to open up for 60 days. Well, you know, we're far beyond 60 days. And just this week, we found out that CFAP 2 sign up will close on October 21st, 2021. So those producers that might need to go in and make some adjustments based on some other things that came out on August 24th, you want to make sure you get that done before we get into the heart of harvest season, because that will close on October 21st. So some of the announcements that came out this week regarding CFAP 2 were some guidance on the payments for eligible livestock and poultry contract producers. So that was out. And also they've tweaked and given some flexibility to the payment calculations for sales-based commodities. Just as a reminder, in CFAP, and again, if you want to get more in depth, go back to listen to some of the recordings that we have, or go onto the CFAP website that is there on the first line. But we had assistance for price trigger commodities. So that would include the corn and soybeans, broilers and eggs. In our livestock markets, we had flat rate crops, which probably here in Ohio, that would mean that might be alfalfa, teff, and triticale. And then we had a whole group in this sales commodities, so sales-based commodities, that were receiving some assistance, and they have given some flexibility to that payment structure. And then grass seed has been added as an eligible sales commodity. So one addition was made, and you can start signing up next week if you're making some of these flexible arrangements. And we'll get into what that is here in a slide after this one. But first, for contract growers, this is something that was out there, we've been waiting on. So they've allocated $1 billion for contract producers of eligible livestock and poultry. So you can see those that could include broilers, pullets, layers, chicken eggs, turkeys, hogs, pigs, ducks, geese, pheasants, quail, and then breeding stock of those eligible livestock and the eggs of the eligible poultry types that are raised by contract producers. So here's another group. The fourth group is these contract producers that may have received a revenue loss, and that revenue loss would have occurred between the January 1st of 2020 through December 27th. So the way the payments will work on this for contract producers, they're based on a comparison. So they're looking at the eligible revenue, the revenue that was received by the contract grower in January 1st, 2019 through the end of 2019, and make that comparison to the same time period in 2020. Of course, with the little flexibility that they have given here, a contract producer can also look at that and say, well, I don't want to use my 2019 numbers. Instead, I can choose to use my January 2018, my January 1st, 2018 through December 27th, 2018. So, and that's what you'll see in the sales-based commodity as well. They've given that flexibility to look back and not use 2019 revenue, but to look back and use 2018. So the producer can use that which is in their best interest. So the sales-based commodities, the ones that they've announced that you can make this substitution of using your 2018 revenue versus using your 2019, that would include aquaculture, goat and milk, floriculture and nursery commodities, which there's a huge laundry list of that, tobacco, specialty crops, again, a big laundry list of specialty crops and livestock both, as well as wool. So for producers that may be raising in these commodity areas, might be worth your time to look at your revenue from 2018 compared to 2019. And then starting next week, make an appointment to visit your folks at Farm Service Agency to go over your specific situation with them. Also announced on August 19th, so just a few days ago, $350 million was allocated for this pandemic market volatility assistance program. And Diane Shoemaker's on vacation right now, but in our next Farm Office Live, I'm sure she's going to go more in depth on this because we will be receiving more detail as it comes out over the next couple of months. So you can guarantee we'll be talking about this program going forward. But something for our dairy producers and those that work with our dairy producers to pick up your ears on, that there's going to be payments made for on an 80% level for the revenue difference per month from July through December of 2020. Of course, as producers, that's going to be capped at 5 million pounds of annual milk production. But the way they're going to do this payment is a little different than the other programs that we've seen here. It's going to be made on regional pooled milk. So the payments will be actually funneled through the independent haulers and cooperatives. So the payment is going to be funneled to, say, your cooperative. And then as it gets there, then they have 30 days to redistribute that back out to the producers. Cool part for us at OSU Extension that there's an in-person education portion of this for dairy farmers, because we understand, and I know Diane will tell you this, that understanding the dairy markets is complex. So they've added this wrinkle in to help explain this all. And in addition to this, they've made some alterations to the dairy margin coverage program, that safety net program, and they've improved it. And the way they've improved it is by updating the feed cost formula in the background to better reflect the cost of purchasing high quality alfalfa. Now, Diane will be discussing more about these in the future. But again, as a dairy producer, someone who works with dairy producers, maybe something you're putting on your radar, start having those discussions with your cooperative or your independent dairy processor and start having those conversations, because those details will be forthcoming. We're only a week from the announcement of this. And then just as a reminder, these are things that we talked about last month. So if you missed those, maybe you want to go back and hear that recording. But there's a pandemic assistance for timber harvesters and haulers program. That sign up started last month. Again, that's going to go through October 15th. So our folks at Farm Service Agency are going to be busy, but that sign up program will be happening through October 15th. So if you have clients or friends in the timber harvesting and hauling business that have had losses in calendar year 2020 in comparison to 2019, they should be checking into that program. And then also last month, we talked about the Pandemic Livestock Indemnity Program, or the PLIP program. And again, that sign up started last month, and that goes through September 17th. So if you're a swine, chicken, or turkey producer, and you had some losses because you couldn't get them to a processing facility, that might be a program that you'll want to check into, especially if you had to depopulate it, that program is for you. So that's just a really, really quick look at what's going on the federal level. When we planned this webinar, in fact, we thought, well, this portion was going to be very small. And here in the last week, we've had some movement. So stay tuned. Check out Farm Office, the website, check out Ohio Ag Manager website, and we'll be putting some articles up on that. And now, I would say, Ben, surely not last. You are last, but you're not the least among us, because some of the conversations we've had with farmers across Ohio was about, hey, how long are these great crop prices going to be around? So we're excited that you are able to come back and rejoin us here to give us a harvest grain market outlook. So Ben, all the way from Missouri back to Ohio, we welcome you.
Yeah, thank you, David, and thanks everybody for joining us today. I look forward to being with you today and kind of going through a harvest grain market outlook. You know, it's wonderful that we can do these virtual events where I can be with you in Ohio, but still be able to get work done here in Missouri too. So I'm excited for this, and certainly we've been getting a lot of questions here in Missouri related to grain market outlook. And I did a field day earlier this week, and most of the producers came up and wanted to know, we talked about a whole range of issues related to farm management, but the thing they really wanted to know is, okay, what do I need to be thinking about from a marketing standpoint as we head into harvest here, which for us could start in the next couple of weeks. We finally got some rain last night to help ease some of our drought issues that we were experiencing here in the state, because for the last month we've had little to no rain, pretty much during a critical stage for soybeans. So I'm going to start off today by just kind of going through my key takeaways. So I'm going to put up my takeaways from today at the beginning, and then we'll go through a couple of different high points. Certainly submit all your questions or any questions you have into the chat box, because I look forward to answering those. And then we'll do a quick summary and wrap up at the end as well. But key takeaways for today: global production shortfalls globally will keep stocks tight through the remainder of the marketing year that starts next week. So for corn and soybeans, it always starts September 1st. And so for the, through the next marketing year, global production shortfalls will keep those stocks elevated. I want to make one point here real quick. When I talk to producers, David's right. Most of them are curious, how long these elevated prices will last. And many of them are under the impression that these high prices are here to stay. And I want to make a point here that there's a difference between a demand rally and a supply-driven rally. Let's start with the demand rallies first. During the ethanol boom back 15 years ago, that created a new demand source for corn that for about 10 years kept corn prices, and in corresponding fashion, soybean prices elevated. We could make the same sort of case as China became a main driver of soy proteins, not just soy proteins, but soy proteins and oil seeds around the globe, as they really started to increase their demand for those products. That was a change in demand that led to some elevated prices. But we've certainly had supply-driven rallies over the last 30 years that tend to be much shorter lived. So in 2012, by the time we got around to August after the drought that summer, by the time we got around to August, we basically printed the high in the corn and soybean market that year. Prices continued to fall through the fall and into the winter as places like South America were able to respond before we could here in the United States. I can make the same sort of case in 2002, 2003. We hit the top of that chart in August, September, 1st of September, and then prices continued to fall. When I look at where we stand today on some of our price issues, this has really been a supply-driven rally. We took 1 billion bushels out of our corn balance sheet last year here in the United States due to a derecho event through Iowa, Illinois, and Indiana, and a late season drought. We also had basically the benefit of dominoes falling for us around the world. South America had, a dry winter this year, taking their corn crop from an expected 110 million metric tons all the way down to 89 million metric tons as of the last report. Ukraine had their driest weather last year in almost 40 years, and as a result, lowered their output of many main crops that they export to the globe now as well. So, the dominoes fell. It was really a supply-driven rally. We did pick up some extra exports into the Chinese market, and those certainly made headways. There are some demand signals there, them changing their swine rations to be much more like what we have here in the United States, including higher concentrations of corn and soybeans, and those will stick around for a while. But they have all those demand signals or demand factors were overshadowed by just shrinking the global picture, and we'll go through that. I do want to remind people that there's a risk out there that COVID is not behind us, and it certainly continues to create challenges both here in the United States and abroad, and we'll talk more about that. Missouri kind of serves as a bellwether for a lot of states. This Delta virus really kicked up in Southwest Missouri, Southeast Kansas, Northwest Arkansas before any other place around the country, and it seems like places are following Missouri about 2 to 3 weeks behind. So when restrictions go on here in Missouri, it's a couple weeks later, and other states start to enact them. The good news I have here is it seems that Missouri is starting to level out. So the Delta virus worked its way through the unvaccinated population, or worked its way, and now we seem to be on the downtrend. Does that signal that other states could be following that pattern 2 to 3 weeks behind as well? So just something to consider because certainly we have seen global challenges. There is the positive, the smaller stocks increase the chances of higher prices, which we've seen, but it also increases volatility. And I don't know about you all, but uncertainty and unprecedented seem to have been buzzwords for the last 18 months. I would add that volatility in the grain markets has been a similar buzzword. We associate a lot of things to volatility, and we'll talk about that as we move forward. I'm going to raise the question today if there's a new sheriff in town when it comes to biofuels. A lot of people follow the ethanol market, and certainly we've had a lot of news related to ethanol in the last month. But do we need to be thinking about other fuels starting to really compete for ethanol share of our biofuel picture? And we'll talk about that. And then we'll wrap up with marketing over the next couple of months as we head into harvest. So I want to remind folks that price is a function of supply and demand modified by the flow of money. This is something that was taught to me when I was an undergraduate student at Kansas State. When I go to the elevator, they always talked about instead of supply and demand, prices were really driven by greed and fear. But the reason many people feel that prices are driven by greed and fear is this flow of money, the amount of money that's flowing into commodity sectors as we go forward. So the good news is that markets are completely predictable, right? I'm kind of saying this tongue in cheek. For a lot of people, you might remember the GameStop frenzy that we had earlier this year. GameStop, AMC theaters, a whole bunch of basically falling and markets that were just drying up. These products, especially movie theaters, really had no positive news, but they all saw surges in their market value on the stock market when there really wasn't a change in any fundamental notion of why those stock prices should be going up. And part of the reason for this is, day traders, people with money were flowing into the market and creating technical changes that cause market prices to fluctuate at drastic levels. Now, the good news is this doesn't happen in agriculture, right? These are just a couple, this is a week. I took screenshots of market prices for a week in June. This was on Monday of that week. Corn prices were down 18 cents. Soybean prices were down 30 cents at the beginning of the week. By midweek on Thursday, corn was down 40 cents and beans had dropped $1.12. That was the largest single day drop ever for the soybean contract. And then to wrap it up at the end of the week, corn was up 22 cents. Beans were up 66 cents. Now, when I was a kid and we used to go to the grain elevator, if there was a 20-cent change in soybean prices in the day, it got people's attention. Everybody wanted to know what was happening, either positive or negative. Those are kind of becoming the norm. Even today, soybean prices, last time I looked, were up 20 cents today. Down 20 cents today as we round out the week. And those are kind of becoming our norm. So volatility seems to have, be here to stay. And again, this is partially due to tighter stocks globally. So these are ending stocks use ratios for the United States, but we can make the same case globally, are at record low or near record low for most of our commodities. For soybeans, that's 3.5% stocks to use after coming down from above 20% at the kind of the beginning of the trade spat with our largest buyer, China. Corn is under 9%. And so certainly we've had these instances where we've tightened things up and helped elevated prices. But this next chart is probably my favorite chart I'm going to show you today. This is corn prices over the last 30 years. And the bars are broken up into different segments. And so the first bars, or the group of bars that you see there, is when corn stocks are less than 10% stocks to use. And we have the different segments. And then the last one is above 16% stocks to use. And as you can see, the yellow bar represents average price levels. So with smaller stocks to use ratios, the price level goes up. But then the black bar here represents that average trading range. And so when we have stocks to use ratios less than 10% for corn, we basically have a $4 trading range, meaning that corn price can go from 7.5 to 350 in a relatively quick manner. And certainly we have seen that this year. We continue to see that for corn and soybeans. And I expect that we will continue to see that throughout this fall, through the winter, and into next spring. So the big thing that has changed is the amount of money that we have invested in commodities throughout our economy. It's not just corn and soybeans, it's other hard assets like land, as Barry mentioned. We've certainly seen land prices this year see sizable increases. And there's a lot of money that is being made available for day traders, people that don't normally trade, but their income was roughly the same through COVID, but then thanks to other sources, not traveling as much, not spending as much due to not going out to eat, maybe they got some stimulus payments, they had money that they felt they could play around with. And so when we look at this chart, basically what this is this is managed money. So people that get in and out of markets very quick. They're not hedging any risk. They're just going to a market, trying to make a few dollars and then getting out, right? And so we call these day traders. And this summer, managed money in corn, soybeans, and Chicago hard winter wheat, soft red winter wheat, and then Kansas City hard winter wheat, reached almost an 8-year high. It's come down from that some as we worked our way through the summer and the risk of a big crop scared some people out of the market, but it's starting to return because corn and soybeans has a story to tell. However, this also creates a downward risk challenge, meaning that if these people decide to exit out, some might get out, that causes the price to shrink, forcing more people or encouraging more people to get out, and then the price continues to fall. And that's largely how we got that $1.12 drop in one day in June. And that's represented here. We had a huge loss in the amount of money, managed money in our commodities. A lot of this is being driven by increases in the Federal Reserve balance sheet. Their balance sheet is up 99% since February of 2020. They've added almost an extra $4.1 trillion to that balance sheet. It was interesting, while I was listening to the presenters before me, I was also watching the Federal Reserve's Jackson Hole Summit to see if the Federal Reserve would change their policy. And they have signaled that they will start tampering their asset purchases. Right now, that's about $120 billion a month, starting to trim their asset purchases down by the start of the year. Just for a visual, the difference between millions, billions, and trillions is represented there in my bullet points. A million seconds is 12 days, a billion seconds is 32 years, and a trillion seconds is 32,000 years. So I just use that as an illustration to talk about exactly how much money we've added to the balance sheet. We've also added $3.2 trillion in federal stimulus that has been released out into the economy. Almost $1.5 trillion is still left to be released that hasn't been allocated. Some of that might be used in the infrastructure bill or even the other bill that Barry talked about initially. The US dollar has fallen about 6.5 or 6.7%. That's positive if you're exporting commodities because it makes our goods cheaper to the rest of the world. However, the dollar is up 400 basis points this morning on the news that the Federal Reserve will start to tamper their assets. Basically, by them tampering their asset purchases, it lowers the dollars that are floating around in the world, and so it pushes up that value of the dollar. So that's not exactly reflecting the change that was made this morning as a result of that Jackson Hole Summit. But then M2 money supply, which takes into account all savings, checkings, and other sources, plus investments, is up 28% since the beginning of the pandemic. So we have lots of money floating around, and some of that is finding its way into our ag commodities. A couple other changes that have been made this year that are contributing to this, volatility is position and price limits have both increased for respective ag commodities. And so if we look here at these position limit increases, these are the amount of contracts any one buyer, whether that's a farmer or whether that's a grain elevator, can take out on any given commodity. And these changes were made because the CME group felt that elevators like ADM, Cargill, and the sources were not being able to manage all of their risk by limiting the amount of positions that they had taken. So you could make a case that this is a function of the consolidation that we've seen in the grain sector. They increased corn futures positions 75%, soybean futures 82%, soybean meal 160%, wheat futures 61%. So you can see some pretty sizable increases in the single month limits that an individual or a company can take out. In correspondence, they also increased the daily price limit. So this is how much a commodity can fluctuate within a day. So corn went from 25 cents as the maximum change in a day to 40 cents. Soybeans went from 70 cents in a day to $1. So increases in the amount of movement we can have in a single day by these commodities. All of this, the amount of the extra money in our markets, increases in position limits, and then increases in price limits has created to this routine volatility that we're now experiencing as we go forward. And then finally, just an end of an era. The CME group, as well as other trading groups around the country, announced earlier this year that they will permanently close a lot of these trading pits. And so some of you might recognize the picture there from Trading Places as they're trading orange juice contracts. But that was really the good old days where people would go to the pit and they would say, I'm selling this many contracts. Somebody saying I'm buying this many contracts. And as a result, we would set a price. The future of our industry is looking at automated or basically computer trading, and this creates increased volatility. We have documentation that traders might react very strongly to a piece of information that comes out that seems bearish, but actually might not have much bearish legs to it, right? So we still have a long ways to go to figure out how algorithms and computer trading react to news that is coming out in the market. I want to talk about global production for just a second. I mentioned this in my opening remarks. This first column here is the 2020-2021 growing season for all countries around the world, right? This last column is our growing season that we're about ready to start. And I'm actually, this here is changed from the previous year as well as changed from the previous year here. The years at the top are what we're looking at. So again, the first column is our current growing season that or last year's growing season, the marketing year we're about to finish up. This is the growing season we're in right now, the crop that's out in the ground. Basically, the thing I want to make is last year, even though the United States had a positive 4%, that was coming after a 2019 where we did have large amounts of prevent plant, right? We took roughly 15 million acres of corn and soybeans out of production in 2019. So last year, even though we had a drought and we had a derecho, we were still 4% up last year. But look at some of the other major producers of corn around the globe. Argentina was down, Brazil was down, the former Soviet Union was down 12%, that Black Sea region. And then China was basically even after expecting to have a good crop. And again, that was partially due to typhoons and extreme flooding through part of their country. This is the expected change for next year. So even though we've had a reduction in supply for our previous marketing year, the next year, the expectation is that a lot of these countries will rebound and that we'll have good production around the globe. Is there a chance that all these places, due to maybe another dry year in Brazil, and certainly we've got a dry year here in the United States, but still better than last year, still expected 4% better than last year due to increased corn acres and better yields. Could we still have this shortfall in production globally? Sure, we could. Is the chance of it, high? No, and it wasn't high last year either, but it did happen. So my message here is, if we really are in a supply-driven market rally and we're expecting better crops next year, what should we expect about the future of grain prices as we head through the winter? Them to continue to fall, right? And certainly we started to see some softness within that over the last couple of weeks. Speaking of the U.S., just real quick, this chart here I've taken from the USDA, so the National Statistics Service, when they put out their yield estimates here in August. And I see Cheryl Turner's on, so I want to give Cheryl Turner a big shout out for the work her and her staff do to support Ohio farmers. But basically what I've done here is I've calculated the percent change in yields by state. So corn is the top number you see in each state and soybeans is the bottom number. So for Ohio, that would amount to about almost a 10% increase in corn production this year versus last, almost a 9% increase in soybean production from last. And certainly, the drought that we've been following all year has certainly made its impact known in the upper plains. And I was just in Fargo last week, and I can contest that the corn and soybeans and wheat in North Dakota is in bad shape. And this whole area up here has become a dominant producer of corn and soybeans, but it's largely being offset by these record yields in Illinois, Indiana, and Ohio. So you all are doing your part to help prop up that national yield when somebody else in the country is having a down spot. If you're a producer, this is actually a good thing, right? To have more product to sell while somebody else is suffering. But as a result of this, there's a lot of corn that is used in this region of Northwest Iowa, Southeast South Dakota, and Southwest Minnesota due to ethanol production and animal feed, right? And so they'll have to work very hard to pull corn out of this eastern corn belt into this region. So expect basis in the West to improve to look very similar to what the basis you all have in Ohio right now. Corn, I was looking at different places. Corn continues to hold very strong in your Ohio market. And I expect that to continue, if not improve, as we move through the winter. And we'll talk about that as it relates to marketing going forward. Now, I mentioned South America is going to get the chance to respond before we do, okay? Part And a lot of the growth in South America has been due to their second crop corn, or their safrinha corn crop. And I've just put this chart in here. The green line is their first crop corn. This yellow line represents the increase in their second corn crop following a full season soybean. And so you can see the rapid increase in their production. They've just recently started adding a third crop of corn. And so I often ask people the question, is Brazil's production seemingly unlimited at the moment? And I would argue that there is a case. Now, eventually, at some point, they will hit their limit. But they certainly have a lot of abilities to increase corn production. Following that up with a good growing season, they had a bad one this year, but a good growing season would push these limits even further. Now, in perspective, the U.S., we produce just a little over 14 billion bushels, and that's roughly about 3 times the size of the entire Brazilian corn crop. However, when we look at exports, and these are the top 4 exporting countries by year, the United States is the world's largest corn exporter by far, but some of these other countries are starting to creep up with us, right? And starting to become a dominant player in the world corn market. Brazil, even though their corn crop is 3 times less than ours, they are really starting to push 1.5 to 1.8 billion bushels of corn exports. And they're playing in our sandbox, if you will, and they will continue to be a competitor as we move forward. The other one I want to point out is Ukraine. Ukraine and that Black Sea region continues to increase production, and they continue to increase their output of corn to the globe. China, with their new Belt Road Initiative, which reminds me a lot of the old Silk Road Initiative, is designed to take goods from Southeast Asia to Europe. Well, guess what? On the way back from Europe to Southeast Asia, that Black Sea region, Ukraine is on the way and has the ability to take ag products into that Southeast Asia market. So just something to consider as we move forward. I want to talk about ethanol production. And again, this is where it kind of comes to my COVID discussion. This chart on the left is daily US cases of COVID. And you can certainly see the rise that we've had really since the end of June in cases. But agriculture probably knows this story better than any other industry, maybe outside the service industry, because they're still struggling. But fewer miles driven due to shutdowns, or people just not feeling confident to get out and travel or go to a store to buy food or to go to a restaurant, does lower ethanol consumption, right? We do not have a volume mandate for ethanol like many people believe. It is a percentage step mandate. And so you lower gasoline consumption, you lower ethanol consumption. We continue to see issues with our global traders and partners by shutting down ports. So just this last week, or 2 weeks, the last 2 weeks, China continues to have their ports run into issues with getting workers to staff their unloading terminals. And as a result, it backs up container ships in the ocean. It backs up ships that people feel comfortable sending ag commodities. And we've seen some slow exports into China and other major importers due to their ports being closed due to COVID. So certainly, there is concern that this increase here in the United States, as well as in other countries around the globe, causes some global logistics issues, or exacerbates the current global logistics issues we have. And that spells trouble for U.S. corn and soybean exports, because we're basically at the very beginning of when we normally start to send soybeans to China. And so if they're slowing down now, what does that mean for our exports of corn moving forward? Now, I want to talk about travel statistics a little bit. On a webinar I think I did with with the farm office team a year ago, or a year plus ago, we talked about when people got vaccinated and we kind of got towards the back end of COVID, would people start traveling more? And I think I was optimistic in the fact that, and I know I was optimistic in the fact that I thought restrictions would be lifted and people would just be traveling like crazy. But you can see the states with populations that are still continuing to work from home. So this is the percent of the population that continues to work from home and will continue to work from home moving forward. This question that was asked by the Bureau of Transportation is, are you going to be working from home 6 months from now? And this was the results of that study. But when we look at the transportation stats, this middle is fuel miles, and the red bar there is 2021. We pretty much got almost back to where we were, just a couple of percentages off where we were pre-COVID after the big dip in 2020. This remaining part's going to be hard to get with this many people still working or planning to work from home. But the big gaps are still in airline travel and even truck mileage, right? And we continue to see large gaps between what they used to drive or travel and what we see today. And that has caused lowering the expectation for fuel consumption moving forward. So ethanol consumption has had a rough month, in the press, but it's also had a rough month when we look at ethanol production and consumption. 7 straight weeks of decline from ethanol production. Now, the good news is that ethanol stocks have also been coming down. If ethanol stocks were rising as production fell, that would signal to me that demand is just terrible. Given the fact that production has fallen and ethanol stocks have fallen, means that production is decreasing faster than ethanol consumption. So there's still, even though we've got weak ethanol consumption, we're still reducing production more than what the decline in demand. And some of this could be just trouble sourcing grain. Several ethanol plants have indicated slowing down production just because they can't source the product, or they're finding difficulty sourcing that product. I've mentioned the rough month in the press. So back at the end of June, the Supreme Court decided to block or to overturn the 10th Circuit Court decision that ethanol or oil refineries could not ask for or receive small refinery exemptions. The Supreme Court overturned that in June. Basically, what that means is now it's up to the current administration or any future administrations in awarding waivers. And so the previous administration here in the United States awarded lots of waivers. The current administration has lots of waivers in the queue to be awarded, but they haven't awarded a ton yet. Could they moving forward, or any future administration moving forward? That is the question, right? So it really depends now on the administration. The next week, on July 2nd, the DC Circuit Court announced that the previous administration overstepped by allowing sales of E15 during the months of June through September. So that had previously been barred. The previous administration announced that they could do that. Ag groups celebrated that because they felt that would help increase the sale of E15, and it did to some extent. It still remains a very small portion of our total ethanol consumption, but now the DC Court has said that they can't do that, and that it goes back to the old rule starting the next driving season, so next summer. If this rule doesn't change, we won't have E15 available in June when the driving season starts. And then last week, we got rumors that the EPA plans to lower the RFS blending volumes, so how we set those percentage standards for the 2021 driving season or compliance period. I want to mention that those are just rumors. We don't actually know. It was announced yesterday that EPA formally submitted their RVOs for 2021 yesterday. It'll be a couple of days before we find out what's in there, but we should know rather quick whether they actually did lower those volumes or not. In all of this, I don't think any of this news changes current ethanol demand, but what it does do is it prohibits the expansion of ethanol for future years and lowers the incentive for retailers to put in ethanol pumps, making it more important for places like the corn growers to continue to invest in providing investments for their companies, as well as the government to provide block grants for companies moving forward. I also want to talk about soybeans real quick. We've seen soybean crush really fall over the last couple of months, largely due to the availability of grain. We've also switched how much of the value of soybean comes from the meal fed to animals versus soy oil. So this is over the last 3 years almost. And you can see the black bar represents the percent of soybean oil. The gold represents the percent of a soybean that is dedicated to soy, or the value soybean meal brings to a whole soybean. And you can see that soybean oil has continued to dominate that market. Part of the reason for this is the expansion and increase in excitement around renewable diesel. And so this is my comment about, is ethanol still the sheriff in town, or is renewable diesel taking over? Real quick, I want to talk about what renewable diesel is. Renewable diesel is a renewable fuel that is chemically the same as petroleum diesel. If you put it in a pipeline, you could not tell the difference between renewable diesel or diesel fuel made from petroleum. It operates the same in tractors, in trucks. It has no impacts that differ from from petroleum diesel, and is a direct substitute. So unlike biodiesel, where you have to blend it, renewable diesel can just be a direct substitute to petroleum-based diesel, and it has a much lower carbon footprint. So it fits into programs like the Renewable Fuel Standard and the Carbon Low Fuel Standard. And so there's a lot of excitement around this because, you know, the argument with ethanol right now is if you increase ethanol blends, you lower the price and encourage more gasoline consumption, which then increases gasoline, raw gasoline made from petroleum, therefore potentially increasing the carbon footprint. With renewable diesel as a direct substitute, you in theory are lowering the carbon footprint the entire time. Now, the primary risk is available fats, oils, and grease feedstocks. Do we have enough to make this widespread? In the United States right now, soybean oil seems to fit into this and prices in very well. Globally, palm oil seems to be the preferred method. And you can see where these renewable plants are going in. None in Ohio yet, but I was just in North and South Dakota, and we spent a lot of time talking about this. But they're basically turning old refineries into renewable diesel facilities. And so they're making that switch. Dickinson up here is the second largest renewable diesel facility in the United States. It is an old oil refinery that they've converted into this renewable diesel. So, you know, it has the potential to be a big driver for soybeans and soybean oil going forward. I want to talk about corn export shifts. So this is the percentage of corn exports from the United States to some of our major buyers. You can see the big increase in China, 934% above what they normally did. Some of our other major buyers also positives this year, which is a good sign as we move forward. But the question is, does China continue to buy at this rate? They contribute about 30% of the almost 60% increase in total U.S. corn exports this last year. And that's maybe where my concern is, but China does have a growing corn deficit. So this is the gold line there is their demand. The black line is how much they produce, and you can see the growing wedge. They've had this wedge in soybeans for a long time, but they've chose to prioritize corn production over soybean production. And just recently that wedge has continued to grow. Part of the issue that's contributing to this is they just haven't had the increase in productivity like what we've seen here in the United States and other parts around the globe. So our corn yield increases about 2 bushels per year. Theirs is increasing about 1 bushel per year. They've recognized that they need to increase their per unit intensive margin. And so they've spent a lot of money investing in research and development. And you can see the black line here is applications for seed varieties for protection patents. The gold line is approved. Those have been approved, and you can see they've been stepping up pretty significantly. The other thing is their diversity in feed grains. So not just corn, but other feed grains as well, including sorghum, DDGs, wheat, barley. And you can see the growth in just total feed demand. In the last USDA report, one of the positives that I think was in the report that people didn't talk about was the reductions in wheat globally. Canada had a 7.5 million metric ton reduction in their wheat crop this year. Russia had a 12 million ton reduction in their wheat crop. The lack of wheat lowers the competition for corn. And so we could see China continue to import corn. And they certainly have had, this gold line represents new crop corn sales. So increasing sales before the marketing year even begins. You can see the big run up last year, this black line that came about July. This year it came in March, April, as China announced big purchases for new crop corn sales, as well as ethanol purchases. The problem that we have is, you know, they have this big tariff. So anything over 7.6 million metric tons gets taxed at 66%. Last year and this year, they're expected to import 26 million metric tons. They have largely turned a blind eye, and by they, I mean the Chinese Central Party, to these taxes. But if they ever started to enforce them again, we would see private companies within China have a rough time importing U.S. corn. So that is a concern as we move forward. So, there was that $423 million bushel buying spree by the Chinese in May. So let me get to the balance sheets real quick, and I'll just wrap up. We'll do corn and soybeans here real quick. This is the marketing year we're about to end. Here in this first column, you can see, you know, the changes in demand and supply up and down the balance sheet. Probably the one that I have the biggest concern with as we wrap up the year is USDA increased corn ethanol production 25 million bushels in August. We're not going to hit that. So I expect USDA to lower this back 25 million bushels in September, which then increases our ending stocks another 25%. There is some bearish news in this corn demand cycle. Feed and residual use is projected down as we look ahead on lower livestock populations. The beef cycle is on its way down, signaling that in future years we should have less cattle on feed. The pork herd is also shrinking ever so slightly. Corn ethanol, as I've mentioned, continues to have its struggles as we move ahead. And then the big question is, we saw the huge increase in corn exports. Do we see, a reduction in that for the next marketing year? And my expectation is we do. As other global producers come back online, Ukraine, South America, we see a strong, or we see competition from some of those players. So there is bearish news in this corn picture as we head into the winter. And I just want that to be kept in mind, that even though we have high prices, there's bearish news ahead of us on the corn side. On new crop expectations, USDA is currently expecting $5.75 per bushel. The current futures market is at $5.50. If we subtract off a normal basis, you're looking at $5.20. And so, USDA is pretty optimistic about that price when the futures market would suggest something more like $5.20 for a season average marketing price. Still above where we were, in previous years, but coming down. On the soybean side, again, a little bit of the same thing. Some bearish news on the demand side, but this is likely due to not being able to source grain. So a limitation in how much grain is out there to be used for products, higher prices, rationing demand. We've seen rationing of demand in the soybean balance sheet for quite a while. When we look ahead to next year, a $13.70 cash price is what USDA estimates. Futures prices at the current levels would indicate somewhere closer to $13.20. $13.26 is the futures price. Just subtract off a normal basis, you're looking somewhere in the mid to upper 12s, $12 range for soybeans as we move ahead. Again, probably the thing I'm keeping my eye on as we look forward is this soybean crush number. Again, with the expansion of renewable diesel on a year-over-year basis, making sure that we have available soybeans for that product.
Hey, Ben,
And so then
before you flip to that, could you go back to the corn slide? We had a question. Should that be 21-22 estimate on the far right, or is that?
Yes, it should. I'm sorry.
Okay,
that's my
that's a
bad.
great
That
catch.
should be
Just wanted to make sure
21-22.
Okay.
So this would be the marketing year that starts next week. Good question. I appreciate that. So marketing for harvest. For old crop corn and soybeans, if you still have some to sell, what are you waiting on? That would be my question. We certainly have had the prices that should have probably emptied out almost all farmers' bins across the country. Both futures and basis are elevated and above historical levels. And so if you've got corn and soybeans, old crop corn and soybeans to move, I would encourage you to think about moving those very quickly. For new crop corn and soybeans, there's still a fair amount of weather risk in this market, especially for soybeans. Part of the drop today is due to the rain that we got and you all got and Illinois and Indiana got over the last 24 hours. That helped the soybean development during pod fill to help round out that yield. So there is still some weather risk in these markets for rain. The store and wait strategy has worked for producers the past 2 years in a row. In 2019, by the time we got around to January of 2020, the government gave out government payments to those that had unpriced grain. And a lot of people that had priced their grain early were upset, rightfully so. And then last year, we had this large price rally through the winter, basically on the smaller than expected global production that I talked about. Will that strategy work in 21, 22? I don't know. And I'm not going to pretend to know that that'll work in 21, 22. All I can say right now is that prices are favorable if you want to market product. Certainly costs have increased and we've done our budgets here in Missouri. It's going to take about a $4.50, $4.60 corn price to break even here in Missouri. So costs have increased pretty strongly due to some of the things I've talked about. But for the wait and store and see strategy, that's worked the last 2 years. My doubts are that probably doesn't work this year. And I would encourage you to think about some risk management. A lot of times we're talking about using options to take care of some of that downside risk. Options are pricey right now. So for an at the money call at $5.50, it was priced roughly at 30 cents, meaning that you would need a corn price at $5.80 to make this pay. And so those are pretty substantial. They have come down some, but they're pretty risky. What I'm encouraging folks to think about, or at least here in Missouri, is this whole option or this whole philosophy around the field of dreams method of, if you build it, they will come. With favorable futures prices, we've seen a lot of volatility in the overnight trading market when volumes are low. Basically, we've shrunk those volumes to a point where there's lots of movement in the overnight markets. I encourage people to go out and put a reasonable price of what they need to be profitable in a futures position in the market. And then a lot of those have been being filled in the overnight market. So it's that whole method of let the market come to you. Certainly the market's been coming down the next day, or even during the night period. But if we can get a pop up during the night due to some of those factors I talked about, we've been filling a lot of these contracts, a lot of these futures contracts. So just something to think about. It's still a futures contract, and so you are hedging your production. And I strongly encourage that, given some of the risks that we have. So my summary is that we will continue to expect sizable swings in commodity markets for a while. Managed money is still large positions. Ending stocks remain tight as we head into the next year. Demand is softening, especially for corn. I think there are some bearish signals in the corn market related both to COVID, lowering gasoline production, and then exports with competition from Brazil and Ukraine really starting to drive some of that as we move ahead. And then the last thing is, there's decent opportunities to market grain right now, and I would encourage you to think about some of that as we look at higher costs heading into 2022. So with that, I am finished. Thank you for your time, and certainly welcome any questions you have.
Well, Ben, as always, that was packed full of information on grain marketing. We appreciate you coming in, and I think we might have, just as a reminder on that, the only thing that came through the chat was a reminder of today's webinar evaluation. We sure do appreciate it. It should pop up as you exit, but if you want to click on that link, you can do that as well. And on the screen, you'll see that our next webinar, our Farm Office Live, will be live from the Farm Science Review on September 23rd from 10 to 11:30 a.m. We'll be working on that, and you can register at go.osu.edu/Farm Office Live. And with that, and Susan said, yeah, my brain couldn't absorb it fast enough. And that is the beauty of why we tape these every time. And that way you can go back to Farm Office Live and you can just watch it again. So if there's something that you miss, of course, the slides are there and also the recording. So with
David,
that,
I've got a question here from Alan.
Okay.
So go ahead, Alan.
Ben, it's been really nice to be in this audience from you today. I'm here at Barry's home office. And what I would like to ask you is this. What's the chance that our foreign buyers have been buying ahead on these export numbers that I read about? And then in anticipation of this higher price that you're talking about for this next year's crop, that they will not be as active in their purchases of our commodities next year as they have been this past year. You understand?
The single word, Alan, high. There's a high chanceability that they will not be as active. And we are certainly seeing that the last, let's just say, month. People in the media continue to, and it's us too. It's even extension specialists like me. I mean, I'll include myself in this category. We have seen increases in daily purchases of corn and soybeans. This morning, there was another daily purchase announcement or sales announcement of both soybeans and corn. Soybeans to China, corn to Colombia. We've had purchases come at a pretty typical rate, if not a little bit higher, but the difference is the quantity is quite a bit lower. So even though we're seeing purchases and we make this out to be that this is ramping up to be just like last year, we're seeing sizably smaller quantities at each given sale. And so I would encourage people I would answer your question by saying that the probability of smaller quantities throughout this next season of sales for international buyers is quite a bit smaller.
Great. Ben, we appreciate it. Alan, we appreciate you being on today there with Barry, getting a behind. In fact, we probably could charge to have people behind the scenes watching as Farm Office Live goes on. And just as a reminder, as we head out, we hope to see you at the Farm Science Review. All your county extension offices across the state of Ohio are selling pre-sale tickets for $7 a piece at our offices up to that Monday before Farm Science Review. So stop in, get your tickets today. We encourage you to check out the Ask the Expert sessions. They roll from 10 to 3 every day on 20-minute topics where we question the experts. we encourage you to see us across from the Fireball building in our brand new tent this year. So we'll see you there. And then our farm office live will be live from the review on September 23rd. With that, we wish you well. Robert, Ben, we appreciate you being part of our program today. And as always, we'll just end with our alma mater. So thanks everyone for joining us.